In this video, we continue looking at ratio analysis for Whirlpool and Whole Foods markets for the period 2012 through 2016. In this segment, we're going to talk about the financial leverage ratios and the profitability ratios. The debt ratio is the proportion of total assets funded with liabilities. All right, so when we look at assets are funded with either liabilities or equity. So with our friends over here at Whirlpool, the debt ratio measures liabilities per dollar of assets, and we can see that they use about 75% debt and 25% equity. And that's up relatively slightly from roughly 70% in 2012-2013 to a little over 75% in the last 3 years. The equity multiplier is a measure that's closely related. The equity multiplier measures the same thing. The higher the equity multiplier, the greater the proportion of liabilities in the capital structure of the balance sheet. That's a lot higher than our guys over here at Whole Foods. Whole Foods was about 30%, or about 1/3 of the assets funded with liabilities, and then that increased to 50% basically in 2016 when they borrowed about $1 billion and used it to buy back shares of stock. Now, the capital structure is one of those long-term decisions, and there are fluctuations from period to period normally. But if we see something like Whole Foods, that's a pretty big change in how they do business. So going from 30% or a third debt to half debt, that was a conscious decision. They didn't have a whole lot of long-term debt at all, and when they added that $1 billion, they didn't have any interest expense to speak of prior to that. The times interest earn ratio measures the operating income available to pay interest relative to the amount of interest expenses. So times interest earned would be EBIT, operating income, divided by the interest expense that has to be paid out of operating income. And you can see both firms are comfortably higher. They have about $5.60 of operating income for every dollar of interest expense. Even though Whole Foods added $1 billion of debt, they still have over 20 times EBIT. They have $20 of operating income for every dollar of interest expense. All right, so the financial leverage over here is much higher over at Whirlpool than it is at Whole Foods, but we also note Whole Foods made a material change in 2016. Now, is that temporary or is that long-term? I don't know. We'd have to see what 2017 numbers show us. Or we could read through the 10K, because it will tell you somewhere in the notes to the 10K why they suddenly added $1 billion of debt to their balance sheet and bought back $1 billion worth of their outstanding common stock. All right, looking at the profitability ratios, we can see that basic earnings power, which is operating income over assets, higher over here for Whole Foods than for Whirlpool. The return on assets is higher for Whole Foods, so their sales profitability, which is the net profit margin, is kind of similar, but the return on assets, because they don't hold as many assets relative to their sales as Whirlpool does, their earnings per dollar of assets is going to be higher. The return on equity went from 10, 17, 14, 17, 19, so it's going to average around 17%, and it's around 14%, 14 to 15% over here for Whole Foods. So return on equity is also reflects not only the return on assets, but it also includes the impact of financial leverage. And we'll do a separate video for DuPont analysis, but that's where this stuff will show us how the impact of leverage actually increases Whirlpool's ROE so much higher over its ROA than over at Whole Foods. All right, so we saw, or you can see if you look at the video on common size statements, the gross profit margin is much lower. It's about half of the gross profit margin of Whole Foods. So gross profit margin for Whirlpool much lower, but the operating profit margin is a bit higher. Well, they're actually pretty comparable. And net profit margin slightly higher for Whirlpool, depending on the year that you look at it. Okay, but very comparable in operating and net profit margin, but a big difference in gross profit margin. All right, so that gives us some of the ratios that we're looking at with financial leverage and the impact of the financial leverage on profitability.